So we have 3 years of income tax expense and income taxes payable that we're going to account for here, and it's not starting with 2016 or 17, it's 2018. So right here in this little chart, we're going to first account for the income tax expense and payable in 2018. And what's important here is to note that there are no, I think right here it says, there are no temporary or permanent differences. So that's nice. That makes this very easy. For 2018, we could say something like taxable income, which we know is an IRS term, is $120,000, and my pre-tax financial income is also the $120,000. And we would need to figure out what my tax rate is for that year, and right here we're told that the enacted tax rate we're looking for 2018 is 40%. So the amount of income tax expense, which is calculated off of pre-tax financial income, is 40% of the pre-tax financial income, and the taxes payable is 40% of the 120. Okay, so what we're going to do at the end of 2018 is record income tax expense of 48,000 and income taxes payable of the same amount. Very simple. So record 2018 income tax expense and payable. For 2019, however, we've got a challenge because we realize we have a net operating loss at this point in time, and the tax rules say, well, you have the option to either take that $570,000 and carry it forward and apply it to future taxable years and to reduce the taxable income at that point, or you can take that 570 and go back 2 years and then forward 20. So we're assuming in this problem we're going to carry it back first. So of the 570, we go back to the 350 first and we fully exhaust that amount. And so maybe I could do something like, I don't know, make a little schedule over here. For 2017, we're going to carry back, so this was the income, there was 350, and for 2018 we had income of 120. And we know that the tax rate at that point in time in 2017 was 34%, and in 2018 was 40%. And so the total carry back amounted to, what was that, 470, and the benefit from it was 167. So we've carried back 470, and we're going to carry forward $100,000 of that net operating loss, and the benefit from the carry back is $167,000. So what happens then is we record first this income tax refund receivable, and there's an IRS form you'd fill out to claim the refund based on a net operating loss, and it's going to amount to this 167. And we would call that a benefit due to the loss carryback. So it's going to reduce my net operating loss in that period, and we'll see how that works its way through on the income statement in a little bit. Okay, but we're going to also record the carry forward of 100,000, right? So the carry forward is going to be $100,000. So the total is the 570. And we would figure out the income tax, the expected income tax benefit related to the carry forward. We'd have to know the tax rate for that period, which is 40%. Because we're told right here the 40% is for the following years as well. So 40%, there's a $40,000 benefit from the carry forward. We don't get to claim that money from the IRS. They're not going to give us 40 grand currently, but they'll allow us to reduce our future taxable income by that net value of $40,000. So we record a deferred tax asset in the amount of $40,000. Okay, and so then that's a benefit due to not the carry back, but the carry forward, and that's 40 grand. So that's the hardest entry, and that's for 2019. Now what happens when 2020 rolls along, and we have $180,000 worth of pre-tax financial income at that point? We're going to record income tax expense. We'll have some form of income taxes payable, what we owe the IRS, And what happens is this deferred tax asset will reverse itself because this entire $100,000 carry forward is going to be eaten up by the $180,000 of taxable income. So my deferred tax asset will reverse, and it will fully reverse in this year. So I would credit that deferred tax asset. It has a value in it of 40 grand. I'm going to credit it for $40,000. My income taxes payable, the amount I owe the IRS, would be calculated as $180,000, this amount right here. Well, you could do it two ways, and maybe this is the worst way to show you, so let me just show you this way. Instead of paying tax on the $180,000, we get to remove $100,000 of that taxable income because of the carry forward. So we're only going to pay tax on $80,000. So 80,000 times the tax rate, which is 40%. We owe the IRS 32 grand. It's the that's the amount we're going to write the check for to the IRS. And so the difference, the income tax expense, becomes a plug. And it's really no coincidence that if you take 180,000, multiply it by 40% tax rate, that's the $72,000 also. It just doesn't happen to be the amount we pay the IRS because they allowed us to carry forward this net operating loss from a prior accounting period and a prior taxing period. So that's it for the first requirement.